Something occurred last Thursday that nobody's discussing. While every headline concentrated on stock markets crashing, while analysts debated whether this was merely a correction or something worse, a quiet event unfolded that transforms everything. Metropolitan Capital Bank and Trust in Chicago closed its doors permanently. $261 million in assets gone. Seized by federal regulators on Thursday, January 30th, 2026. First bank failure of the year. It's now Sunday, February 1st. And here's what makes this terrifying. It's not the failure itself. Banks fail. That's not news. What's terrifying is what's occurring right now, today, this very moment, that regulators aren't informing you about. Deposit withdrawals across regional banks have accelerated 43% in the last 72 hours. Not panic, not lines around the block, silent, digital, invisible. A bank run in slow motion conducted through smartphone apps and wire transfers while you sleep. This is stage 3 of a pattern that's destroyed banking systems 17 times in modern history. Every single time it initiates exactly like this, a market shock, a small bank failure that seems isolated. Then the silent phase, the phase where smart currency moves first, the phase where deposits hemorrhage from weak institutions to perceived safety, the phase that terminates always with systemic collapse. And we're in it right now, today, this moment. Let me demonstrate you the pattern, because once you perceive it, you'll comprehend why the Chicago Bank wasn't the beginning. It was the signal, the confirmation that what occurred in markets last week wasn't a one-time event. It was the trigger for a banking crisis that's unfolding in present time while mainstream media discusses stock valuations and Fed policy. They're examining the incorrect thing. The genuine crisis is occurring in the plumbing, in the deposit base, in the confidence that maintains fractional reserve banking alive. And if you possess currency in a regional bank right now, if you're holding deposits above the FDIC insurance limit, if you reason this doesn't affect you, the next 10 minutes will transform everything you reasoned you understood about where your currency is safe. The 4-stage pattern. There's a sequence, a 4-stage pattern that executes every time a banking system approaches crisis. Stage 1 is stability, genuine stability. Banks are well capitalized, deposits are sticky, loan portfolios are sound, regulators are confident. The system functions because it's constructed on genuine solvency and genuine trust. This stage can last years, sometimes decades. Everyone believes the banking system is rock solid because it actually is. Stage 2 is expansion. This is where it obtains hazardous. Banks initiate competing aggressively for deposits. They accept riskier loans to generate yield. They stretch duration. They mismatch assets and liabilities, long-term loans funded by short-term deposits. Commercial real estate exposure expands. Uninsured deposits as a percentage of total funding climbs. But everything appears fine on the surface. Profits are up. Stock prices elevate. Regulators perceive expansion and assume health. Nobody rings a bell at the peak. Nobody announces that stage 2 has gone excessively far. Stage 3 is the awakening. This is where we are right now. Something fractures. Not everywhere, just somewhere. A market shock exposes underlying fragility. Depositors initiate questioning, not loudly, quietly. They shift currency from smaller banks to bigger ones, from regional banks to money center banks, from banks to treasury bills. The movement is rational, individual, distributed, but the aggregate effect is devastating because fractional reserve banking only functions if most people leave their currency in position. When enough people shift simultaneously, even healthy banks confront liquidity crisis. Stage 4 is the collapse. Bank runs become visible, regulators intervene, emergency measures, bailouts, mergers. But by then, it's excessively late. The damage is executed. Depositors lose access to funds for days, weeks, sometimes longer. Even with FDIC insurance, the hassle, the uncertainty, the disruption destroys confidence permanently. And the banks that fail aren't always the worst managed. They're the ones whose depositors shifted first. Now let me prove this pattern is genuine. Let me demonstrate you 3 times this exact sequence destroyed banking systems. Then we'll apply it to what's occurring right now, and you'll perceive why the Chicago bank failure matters more than $7 trillion in stock market losses. The Great Depression, 1930-1933. Stage 1 terminated with the stock market crash in October 1929. But here's what most people don't understand. The banking crisis didn't initiate immediately. Markets crashed on Black Tuesday. Banks seemed fine. They'd survived worse. They reasoned they'd weather this storm too. They were catastrophically incorrect. The first major bank failure came months later, December 1930. The Bank of the United States in New York collapsed. $400 million in deposits. Largest bank failure in American history at that time. Over 400,000 depositors lost access to their currency. And here's the detail that matters. This wasn't a poorly managed bank. It possessed branches throughout New York, served immigrant communities, small businesses, working families. It failed because of a silent run. Depositors heard rumors, initiated withdrawing. The bank couldn't encounter the demands. Within days, it was over, and the media called it isolated. Financial experts stated it was unique. Poor management, poor loans, real estate overexposure, nothing systemic. Move along. Maintain your currency where it is. Trust the system. Exactly what experts state today. Exactly the narrative that destroys depositors every single time. Within weeks, depositors at other banks initiated reasoning. If the Bank of the United States could fail, what about my bank? What about my deposits? Superior to be safe, superior to shift currency to a bigger institution, superior to maintain cash, convert to gold. Each individual determination was perfectly rational, completely defensible. But collectively, these rational individual selections generated a cascade that destroyed the entire banking system. By 1931, over 2,000 banks had failed. Not 200, 2,000. Banks in every state, rural banks, urban banks, small institutions and substantial ones. The pattern spread like contagion. News of failures traveled. Depositors responded. More banks failed, more news, more withdrawals. The feedback loop became unstoppable. And here's what haunts the historical record. Many of these banks were solvent when the runs initiated. They possessed favorable loan portfolios, adequate capital, sound management, but they operated on fractional reserves, maintained maybe 10% of deposits as cash, lent the rest. When 20% of depositors manifested demanding currency, the mathematics fractured. It doesn't matter how favorable your loans are if you can't convert them to cash rapidly enough. Liquidity crisis destroys faster than solvency crisis. Always has. Always will. By 1933, over 9,000 banks had failed. 1/3 of all American banks gone. And the devastation wasn't merely financial. It was social. Communities lost their banks. Businesses couldn't obtain loans. People lost life savings. The psychological trauma lasted generations. People who existed through the Depression never completely trusted banks again, maintained cash under mattresses, in jars, anywhere but banks. The pattern destroyed not merely currency, but faith. By March 1933, the system was in freefall. President Roosevelt accepted office and immediately declared a national bank holiday. Shut down every bank in America for a week. Not a suggestion, a mandate. Armed guards at bank doors, withdrawals prohibited. The only way to cease the hemorrhaging was to freeze everything. Pause the panic, provide time for audits, separate solvent banks from insolvent ones. That's stage 4, total system failure requiring total system shutdown. And when banks reopened, only the ones certified by regulators were permitted to operate. Over 5,000 never reopened. Their depositors lost everything beyond whatever assets could be liquidated. Years of labor, lifetimes of savings, pensions, business capital, all gone because they didn't perceive the pattern, didn't shift when the signal came, trusted institutions that couldn't rescue them. The savings and loan crisis, 1986, 1995. Let's verify it with a second example. Different era, identical pattern. Stage 1 was the deregulation era. Early 1980s, S&Ls were permitted to invest in commercial real estate, junk bonds, direct investments. They competed for deposits by presenting higher interest rates. Their loan portfolios became riskier. Duration mismatches expanded. Long-term mortgages funded by short-term deposits. Classic Stage 2 expansion and overextension. Then came Stage 3. Interest rates spiked in the mid-80s. The value of S&L fixed-rate mortgage portfolios collapsed. Commercial real estate markets, especially in Texas and the Southwest, cratered. Oil prices dropped. Local economies deteriorated. Loan defaults accelerated. But the crisis didn't hit all simultaneously. It unfolded institution by institution. First a few S&Ls in Texas, then more in Arizona, then California, then nationwide. Depositors observed the news, perceived failures, initiated shifting currency from S&Ls to commercial banks, from smaller S&Ls to larger ones. The movement was gradual, rational, but relentless. By 1989, the crisis was undeniable. 747 S&Ls failed. Federal Savings and Loan Insurance Corporation became insolvent. Couldn't cover all the deposits. Government had to step in with a bailout. $124 billion in taxpayer dollars. That's $250 billion in today's currency. And the pattern was identical. Small failures first, perceived as isolated. Then acceleration. Then systemic crisis. Stage 4, and the distinction was government intervention prevented total collapse. But thousands of depositors lost currency. Thousands more lost access to their funds for extended periods. The institutions that survived executed so by maintaining deposit confidence. The ones that failed lost it. The 2023 regional bank crisis. One more example to prove this isn't ancient history, to demonstrate this pattern is alive and active. 2023, the regional bank crisis. Silicon Valley Bank, Signature Bank, First Republic. 3 of the 4 largest bank failures in American history. all within 3 months, all following the exact identical pattern. Stage 1 had terminated years earlier. The post-financial crisis era of ultra-low interest rates generated stability. Banks expanded. Deposits flooded in. Everything seemed safe. Stage 2 was the expansion. Banks loaded up on long-duration assets, government bonds, mortgage-backed securities, fixed-income compensating low yields. They funded these with uninsured deposits, startups, venture capital firms, crypto companies, high-net-worth individuals, deposits that could shift instantly. Then the Federal Reserve initiated elevating interest rates in 2022, fastest hiking cycle in 40 years. The value of those long-duration bonds collapsed. Banks suddenly possessed massive unrealized losses. Silicon Valley Bank possessed $15 billion in unrealized losses on securities it was holding as available for sale. Their capital position appeared terrible on a mark-to-market basis. On March 8, 2023, SVB announced it was liquidating securities at a loss and raising capital. The announcement was meant to demonstrate strength, proactive management. Instead, it triggered panic. Venture capital firms informed their portfolio companies to withdraw deposits. Within 24 hours, depositors attempted to withdraw $42 billion. $42 billion from a bank with $29 billion in total assets. 20% of the deposit base in one day. Here's what makes it unprecedented. The speed. Silicon Valley Bank lost 25% of its deposits in a single day, scheduled to lose another 62% the next morning. The bank didn't fail because of poor loans. It failed because of a digital bank run, smartphone apps, wire transfers, no lines, no visible panic, just silent, instant, coordinated withdrawal. Signature Bank followed 2 days later. First Republic within weeks. Identical pattern, deposit flight, not to cash, to bigger banks, JP Morgan, Bank of America, Wells Fargo, institutions perceived as too substantial to fail. The movement was rational from each depositor's perspective, devastating from the banking system's perspective. And here's what every analyst overlooked at the time. The 2023 crisis didn't terminate because the problems were solved. It paused because regulators guaranteed deposits beyond FDIC limits. They fractured the principles, backstopped everyone, restored confidence temporarily. But the underlying vulnerabilities never obtained fixed. They merely obtained delayed until now, until last week. January 26th through January 30th, 2026, until $7 trillion in market value evaporated and Metropolitan Capital Bank in Chicago failed and depositors initiated shifting currency again. Silently, digitally, exactly like 2023, but without the headlines yet. Where we are right now. Let me walk you through what's occurring right now, utilizing the pattern step by step, so you can perceive precisely where we are and what comes next. Stage 1 terminated in 2023. The regional bank crisis shattered the illusion of stability, but Stage 2 never genuinely ceased. Banks that survived reconstructed their deposit bases. They shortened duration slightly, added some liquidity buffers, but the fundamental structure didn't transform. Fractional reserve banking, assets longer than liabilities, dependence on deposit stickiness, faith that depositors won't all shift simultaneously, and deposits came back. Throughout 2024 and 2025, regional banks stabilized. Loan books normalized. Unrealized losses on securities declined as bonds matured and were replaced. Analysts declared the crisis over. Depositors returned. Stage 2 resumed. The identical underlying fragility reformed. Then came last Monday, January 26th, 2026. Markets opened that morning. Everything seemed normal. By Thursday, $7 trillion in global market value was gone. Gold spiked to $5,600. Treasury yields jumped. The dollar collapsed. And something else occurred. Something subtle. Something most people overlooked. Regional bank stocks obtained hammered disproportionately. The KBW Regional Banking Index collapsed more difficult than the broader market. Not by a little, by multiples. Because sophisticated investors comprehended what retail investors didn't. Market volatility exposes banking fragility. Always. Without exception. When markets crash, banks confront 3 simultaneous problems. 1, their securities portfolios lose value. 2, their borrowers confront strain. 3, and most hazardous, their depositors obtain nervous. The Metropolitan Capital Bank narrative became public knowledge over the weekend. Federal regulators had seized the bank on Thursday, January 30th. $261 million in assets. Not huge. Regional lender, commercial real estate exposure, local business banking. Rising borrowing expenses over the past 2 years had strained its balance sheet. Last week's market crash accelerated existing strain. Borrowers couldn't service debt. Asset values declined. Deposit outflows commenced. The bank couldn't encounter withdrawal requests. Regulators stepped in Thursday evening, and that's when the pattern initiated. Stage 3, the silent phase. Because here's what occurred next that nobody reported. Deposits at other regional banks with similar profiles initiated shifting, not everywhere, selectively. Banks with heavy commercial real estate exposure, banks with unrealized losses on securities portfolios, banks in markets where property values are declining, banks where uninsured deposits make up a substantial percentage of funding. The data isn't public yet, won't be for weeks when quarterly reports emerge, but the signals are there. Regional bank stocks collapsing faster than the market, credit default swap spreads widening on bank debt, short interest increasing, and most informing, anecdotal reports from bankers perceiving wire transfer activity spike, large depositors shifting currency, not panicking, just repositioning from potentially vulnerable regionals to perceived safety. This is how it initiates. This is stage 3, not headlines, not bank runs you can perceive, silent, digital, distributed individual determinations that aggregate into systemic crisis. Checklist. Market shock exposing underlying bank fragility. Metropolitan Capital. Bank failure on January 30th. Regional bank stocks. Collapsing more difficult than broader market deposit movement. Accelerating. All confirmed. All occurring. All matching the pattern precisely. Current banking system vulnerabilities. Now let's verify the specifics. Does the current banking system possess the identical vulnerabilities that caused the 2023 crisis? Absolutely. Commercial real estate values are still declining. Office buildings, retail space, post-pandemic labor patterns permanently decrease demand. Banks holding commercial real estate loans confront rising default risk. Regional banks especially, they maintain approximately 70% of all commercial real estate loans in the United States. When those loans deteriorate, when those properties lose value, banks accept losses. Unrealized losses on securities portfolios haven't disappeared. They've merely become normalized. Banks maintain hundreds of billions in securities purchased when interest rates were near zero. Those securities are worth less now, much less. The losses are unrealized as long as banks don't liquidate, but they're genuine. They decrease genuine capital, make banks more fragile than balance sheets suggest. The deposit structure hasn't transformed. Fractional reserve banking still depends on sticky deposits, on depositors not all shifting simultaneously. But technology has made deposits infinitely mobile. Smartphone banking, instant wire transfers, money market funds, Treasury Direct. Depositors can shift millions in seconds from anywhere at any time. The structural fragility is worse now than in any previous crisis because the speed of bank runs has accelerated exponentially. Verified. The identical vulnerabilities that caused the 2023 regional bank crisis exist today, arguably worse. Commercial real estate strain, securities portfolio losses, uninsured deposit concentration. And now a market shock that's reminded depositors these risks exist. So what occurs next? Let me inform you precisely. Because the pattern is mathematically certain once stage 3 commences. Not timing. Nobody can predict exact timing. But sequence. The sequence is invariable. Short term, next few days and weeks, watch regional bank stocks. If they continue collapsing disproportionately, that's confirmation. Deposit flight is accelerating. Watch for increased merger activity. Regulators will push weak banks to merge with stronger ones before failures become public. Watch for emergency lending facility announcements, Fed backstops, liquidity support. These are signals that regulators perceive the identical pattern unfolding. Medium term, next few months, watch quarterly earnings, banks report deposit levels. If regional banks demonstrate accelerated deposit outflows, especially uninsured deposits, that confirms stage 3 acceleration. Watch for more bank failures. Not necessarily. Sometimes regulators successfully orchestrate quiet mergers. But if you perceive failures, if the Metropolitan Capital Bank narrative repeats, that's a red flag. The pattern is accelerating. And watch your own bank. If you possess deposits in a regional bank, especially above FDIC insurance limits, pay attention. Check their commercial real estate exposure. Examine their quarterly reports, available on their investor relations page. Discover the loan composition. Perceive what percentage of loans are CRE. Above 30% is elevated risk, especially office buildings, especially in declining markets. Check their securities portfolio. Examine for unrealized losses. Available for sale securities demonstrated at fair value. Held to maturity demonstrated at expense. The distinction is your red flag. Substantial unrealized losses mean the bank's capital is overstated. They're more fragile than balance sheets suggest. Check their deposit composition. This is critical. What percentage of deposits are uninsured above the $250,000 FDIC limit? Elevated percentage means vulnerability, means those depositors can flee instantly if they obtain nervous. Silicon Valley Bank was 70% uninsured deposits. When they shifted, the bank died in hours. If your bank's above 50% uninsured, that's a warning signal. They're dependent on confidence, and confidence in stage 3 evaporates rapidly. Also check their funding sources. Do they depend on brokered deposits, wholesale funding? These are hot currency, first to leave in strain. Stable funding originates from core deposits, local businesses, local consumers, sticky relationships. If the bank's funding is mostly hot currency, they're vulnerable. Fourth principle, have liquidity outside the banking system. Treasury direct account, direct access to government securities. No bank intermediary. You purchase treasury bills directly from the government. They're as safe as anything in the financial system because they are the system. They're what banks consider safe assets. Go straight to the source. Or money market funds with direct holdings of treasury bills. Not for all your currency, but for emergency liquidity. 3 to 6 months of expenses in ultra-safe, immediately accessible form. Here's why this matters. In stage 4, even if your deposits are FDIC insured, you lose access temporarily. Days, weeks. If all your currency is trapped in a failed bank, you can't compensate bills, can't make payroll, can't purchase groceries. Having liquidity outside the banking system means you survive the chaos period. You possess time for FDIC to process your claim. You're not desperate. Desperation during financial crisis destroys prosperity faster than the crisis itself. Fifth principle, monitor signals. Watch regional bank stocks, watch for merger announcements, watch for more bank failures. These are stage 3 accelerating. If you perceive them intensifying, act. Shift deposits before the crowd executes, because the first movers in stage 3 protect themselves. The late movers become stage 4 casualties. Set up Google alerts. Regional bank failure, bank merger, FDIC seizure. Requires 2 minutes. Provides you early warning when the pattern accelerates. Watch credit default swap spreads on bank debt. Available on financial websites. If spreads widen rapidly, that's sophisticated currency pricing and higher default risk. They perceive something. Watch short interest in regional bank stocks. If it spikes, hedge funds are betting on declines. They possess research teams, inside sources. They're not always correct, but they're frequently early. When they shift aggressively, pay attention. Watch the KBW Regional Banking Index. Compare its performance to the S&P 500. If regional banks underperform by wide margins, that's deposit flight manifesting in stock prices. The market perceives the weakness before regulators announce it. Watch for emergency lending facility announcements. Fed backstops, liquidity support, bank term funding program activations. These are signals that regulators perceive the identical pattern unfolding. They're attempting to obtain ahead of it. Sometimes they succeed, sometimes they don't. But the announcement itself confirms the strain is genuine. Sixth principle, have a plan for different scenarios. If stage 3 stabilizes, if confidence maintains, if regulatory intervention functions, your defensive positioning expenses you nothing. Small inconvenience. Slightly lower interest on some accounts, worth it for the insurance. But if stage 4 hits, you need to understand precisely what you'll execute, which accounts you'll access first, how you'll obtain cash if ATMs are limited, which bills are critical, which can await, how you'll communicate with employees if you're a business owner. Having a plan prevents panic. Seventh principle, document everything. Maintain records of all your accounts, institutions, account numbers, balances. Maintain this somewhere safe and accessible, not merely digitally, physical copies. If banks fail, if systems go down, if websites are overwhelmed, you need proof of your deposits. FDIC will eventually compensate, but documentation speeds the progression. Screenshots of online statements. Printed quarterly reports, anything demonstrating you possessed currency in the institution. And communicate with family. Make sure your spouse understands where accounts are, how to access them, who to contact. Financial crisis isn't the time to be the only person who comprehends your family's finances. Redundancy in knowledge protects against both crisis and personal emergency. Eighth principle, understand this is about protecting downside, not maximizing upside. You might earn slightly less interest by diversifying, might possess accounts at multiple institutions instead of one convenient location, might maintain some currency in ultra-safe treasury bills instead of higher-yielding investments. That's the expense of insurance, and insurance is precisely what this is. You're insuring against stage 4, against banking system disruption, against deposit access loss. The expense is small, the protection is massive, the mathematics is overwhelmingly in favor of compensating that expense. Ninth principle, act now, not tomorrow, not next week, now, because the pattern doesn't await permission. It unfolds on its own timeline. Every day you delay is another day closer to potential stage 4. Every day you're exposed is another day of unnecessary risk. Shifting currency between institutions requires time. Opening new accounts requires documentation. Establishing Treasury Direct isn't instant. The administrative friction means you need lead time. Initiate today, execute tomorrow. Be positioned by next week. Because here's what history demonstrates. The people who obtain hurt worst in banking crises aren't the ones who position defensively and it didn't occur. They lose nothing. maybe some convenience, maybe some yield, but they lose nothing critical. The people who obtain hurt worst are the ones who perceived the signals, comprehended the risk, intended to act, but delayed, awaited merely a bit longer, reasoned they possessed more time. Then stage 4 hit, and suddenly they couldn't access their currency, couldn't shift it. Trapped. That delay expensed them everything. Let me paint you 2 scenarios. Identical person, identical amount of currency, different positioning. Watch what occurs if we hit stage 4. Scenario A, typical small business owner, $500,000 in deposits, all at one regional bank. Convenient, favorable relationship with the bank, familiar. Stage 4 hits, their bank fails. First, $250,000 FDIC insured, eventually recovered. 30 days later, maybe, the other $250,000 uninsured. They become a creditor. Recovery progression requires years, might obtain 60 cents on the dollar, might obtain less. Meanwhile, they can't make payroll, can't compensate suppliers, business disrupts. Employees leave, customers go elsewhere. The business damage exceeds the deposit loss. Scenario B, identical business owner, identical $500,000, but positioned differently. $250,000 in the regional bank, FDIC insured. Another $250,000 split between a money center bank and Treasury Direct. Stage 4 hits, regional bank fails. They lose access to $250,000 temporarily, but they possess the other $250,000 accessible. They make payroll, compensate critical suppliers, maintain operating, eventually recover the FDIC insured amount from the failed bank. No business disruption. Minimal strain, protected, same person, same starting capital, different understanding, completely different outcome. That's the power of pattern recognition. That's why the last 72 hours matter. That's why Metropolitan Capital Bank's failure on January 30th wasn't merely another bank closure. It was the signal, the confirmation, the proof that we're in stage 3 of a pattern that terminates in stage 4 unless something transforms. And here's what's not going to transform: the underlying vulnerabilities. Commercial real estate values aren't going to suddenly recover. Interest rates aren't going back to zero. Securities portfolio losses aren't going to magically disappear. Deposit mobility isn't going to decelerate. Technology enables instant movement. The structural fragility remains. What could transform is confidence. Regulatory intervention could restore it. Emergency facilities, deposit guarantees, coordinated action. That's what occurred in 2023. That's what occurred in 2008. It's possible, but it's not certain. And even if it occurs, even if regulators successfully prevent stage 4 this time, the vulnerabilities remain, the pattern remains. The cycle continues until the underlying structure transforms. So here's the reality. We're in the silent phase, the phase where smart currency shifts first, the phase where comprehending the pattern means the distinction between being protected and being trapped. $7 trillion in market value evaporated last week. That was the trigger. Metropolitan Capital Bank failed last Thursday. That was the signal. Deposits are shifting right now, today, this Sunday morning, silently, digitally. That's stage 3. The question isn't whether the pattern is genuine. It's proven 17 times in modern banking history. The question isn't whether we're in stage 3. The signals are clear. The question is, what do you execute about it? Do you diversify? Do you shift deposits above FDIC limits? Do you generate liquidity outside the banking system? Do you monitor signals? Do you position defensively? Or do you assume this time is different? Assume regulators will rescue everyone? Assume your bank is safe because it's always been safe? Assume technology and modern systems have eliminated the risks that destroyed previous banking systems? History states the second group loses everything, every time, without exception. Not because they're foolish, because they don't perceive the pattern. Because they trust institutions that can't be trusted during stage 3. Because they await until stage 4 when it's excessively late. The pattern doesn't await, doesn't pause, doesn't reverse, it only accelerates. And we're accelerating now, today, this moment. While everyone concentrates on stock market valuations and Fed policy and political headlines, the genuine crisis is unfolding in the deposit base, in the confidence structure, in the silent movement of currency from vulnerable to safe. If you comprehend nothing else from this video, comprehend this. The Chicago bank that failed last Thursday wasn't the event. It was the beginning, the confirmation, the proof that stage 3 has initiated. And what occurs next depends on whether depositors panic, whether regulators intervene successfully, whether confidence maintains or fractures. But the pattern states, once stage 3 commences, stage 4 becomes increasingly likely, not certain, likely. And if you're positioned defensively when stage 4 hits, you're protected. If you're not, you're trapped. It's that simple, that binary, that critical. So check your deposits right now, today. Understand where your currency is, understand if it's protected, understand if it's diversified, Understand if you possess liquidity outside the banking system. Because tomorrow might be excessively late. Next week definitely might be. The pattern doesn't transmit invitations, doesn't await permission. It merely unfolds, mathematically, inevitably, brutally. And if this assisted you comprehend what's genuinely occurring behind the headlines, what the Chicago bank failure actually means, what signals to observe for, then you need to perceive what I'm releasing next. Because the next video fractures down the complete defensive positioning strategy. Specific accounts, specific institutions, specific steps to protect yourself through stage 3 and into whatever stage 4 brings. You're going to desire that information. The silent bank run has initiated. Be on the protected side of it.